In January 2026, subprime auto loan delinquencies hit a 32-year record high. Banks are repossessing cars faster than any cycle since 2008, and the people who paid cash for their cars are losing the most money of all. Wait, paying cash is supposed to be the smart move, right? That's exactly what the dealership wants you to believe. I want you to meet two buyers. Same week, same city, same exact truck. Buyer A walked into a Toyota dealership last March with $35,000 in cash, slapped it on the desk, drove off in a Tundra, felt like a king. Buyer B, same truck, same dealership, same week, financed the entire thing. 6 months later, one of them was broke. And it wasn't the one you'd guess. By October, Buyer A's transmission gave out. $8,000 repair. His emergency fund? Gone. He'd used it on the truck. His credit card? Maxed. His savings? Drained. He missed 2 mortgage payments. His credit score dropped 140 points. Buyer B, the one who financed, paid his mechanic with cash from his savings account. The same savings account that had been quietly earning 4.3% in a high-yield account all year. Same truck, same week. Completely different outcomes. And here's what nobody's telling you about 2026. Right now, as we speak, 3 things are happening at the same time. 1. Subprime auto delinquencies are at a 32-year high, the highest level since 1994. 2. The average new car payment just hit $767 a month, an all-time record. 3. Total American auto debt is $1.67 trillion. That's 57% higher than 10 years ago. Translation? The credit system is buckling. And when credit buckles, cash isn't king. Cash is bait. Because the moment you hand over $35,000 at a dealership, you've just done 3 things that benefit the dealer and hurt you. Let me show you exactly what they are. Mistake number 1, the liquidity trap. Liquidity is the most underrated word in personal finance. It just means, how fast can you turn an asset into cash without losing money? Your truck? Not liquid. The second you drive it off the lot, it loses 10 to 15% of its value. If you need cash next month for a medical bill, for a roof leak, for a job loss, you can't sell that truck for what you paid. You'd lose $4,000 to $6,000 trying to undo the transaction. Now compare that to buyer B, the one who financed. He kept his $35,000 in a high-yield savings account at 4.3%. That's $1,505 in interest in 1 year. Risk-free, FDIC insured. His monthly truck payment? $589 at 6% APR. His monthly interest earned on the cash he didn't spend? $125. Net cost of staying liquid? $464 a month. For the peace of mind of having $35,000 available the day disaster hits. That's not a bill, that's an insurance premium against the next crisis. Mistake number 2, the dealer margin trap. Wait, what? Yeah. Most people think paying cash gets you a discount. It does the opposite. Here's the secret the F&I office doesn't want you to know. Dealerships make the majority of their profit not on the car, but on the financing. Every time they sell you a loan, the bank pays them a commission, sometimes 1 to 3% of the loan amount. On a $35,000 truck, that's $350 to $1,000 of pure profit for the dealer. So when you walk in with cash, you just told them you're worth nothing on the back end. Their incentive to negotiate on the front end price disappears. Here's the move smart money makes instead. You tell them you want to finance. You let them quote you a price. You negotiate the out-the-door price down hard because they're protecting their back-end commission. Then you sign the loan and pay it off in the first 30 days. Most dealer finance contracts have no prepayment penalty. You just save $2,000 to $4,000 on the price, and the dealer can't legally claw back the discount. That's the opposite of what they trained you to believe. Mistake number 3, the opportunity cost trap. You forgot what your cash could have done. Economists call this opportunity cost. Working families call it the bill they didn't know they were paying. Let's run the real numbers. $35,000 in a high-yield savings account at 4.3%, $1,505 in year 1. Risk-free. $35,000 in a conservative index fund averaging 8%, $2,800 in year 1. Higher risk. $35,000 used to pay off a credit card charging 22% interest, $7,700 saved in year 1. Guaranteed return. Or $35,000 sitting in a depreciating asset that lost $5,000 of value the moment you drove it home. Look at those 4 numbers. Plus $1,500, plus $2,800, plus $7,700, minus $5,000. Paying cash for that truck didn't cost you $35,000. It cost you $35,000. Plus the opportunity you walked away from. That's a $10,000 mistake minimum that nobody put on the sticker. So here's what wealth protectors actually do, especially right now, in 2026. Step 1. Get pre-approved at your credit union or bank, not the dealership. Walk in with that pre-approval in your back pocket. Don't show it yet. Step 2. Negotiate the out-the-door price, not the monthly payment, the total price including tax, title, fees. Make them work for the sale. Let them think you're financing through them. Step 3. When they offer you their finance rate, compare it to your pre-approval. If theirs is lower, take it, sign it, pay it off in 30 days. If yours is lower, use yours. Step 4. Whatever rate you take, keep your cash working. Split it 3 ways. 6 months of expenses in a high-yield savings account. Pay down any debt above 8% interest. Invest the rest into low-cost index funds or short-term treasuries. Your truck makes the payment. Your cash makes you wealthier. That's how you turn a depreciating purchase into a wealth-protecting decision. Here's what makes 2026 different from any other year. Tariffs are projected to add $3,000 to $10,000 to new car prices. Subprime borrowers are getting locked out of the market, which means used car prices may surge again. Auto repossessions are climbing in nearly every state, and the families who tied up their cash in depreciating vehicles are the families with nothing left to defend themselves when the next layoff, the next medical bill, the next storm comes. The wealthy don't pay cash for depreciating assets in a credit-stressed economy. They keep their liquidity, they keep their leverage, they keep their options. And right now, options are the only thing protecting a working family from the next downturn. If this changed how you think about your next big purchase, hit subscribe and turn on the bell. Next video, I'm breaking down the $40,000 mortgage mistake that's quietly bleeding working families dry in 2026, and what wealth protectors do before the next recession hits. Drop a comment below. Tell me, have you ever paid cash for a car? Would you do it again? This video is for educational and informational purposes only. It is not financial, tax, legal, or investment advice. All examples, figures, and strategies are illustrative and based on publicly available data and historical patterns. Your personal financial situation is unique. Consult a licensed financial advisor, tax professional, or attorney before making any major financial decision. Elite Grind Group is not a licensed financial advisor and makes no guarantees regarding any outcome or return. Stay focused, stay consistent, stay elite.